Now today you're going to hear about leverage annuity plans, and these plans are pretty popular in the market these days. So what is an annuity if you're not familiar? An annuity pays you lifetime income stream similar to CPF Life. Now let me put some parameters to today's discussion. In this video, I can't really put specific plan names because I have restrictions. I'm a licensed advisor and there are actually regulators watching this video with you right now. So I actually can't put names to the plans itself, but I'll describe roughly the benefits, and more importantly, I'll describe the cons, risk that you should be aware of, especially if you are hearing pitches when you walk to a bank or walk to a financial advisor, or even myself when I present. Hopefully you understand the various point of views to look at. Now this video I'll be touching on leverage annuities simply because I've seen this question coming up quite a lot of times on this community. I wanted to address it, and increasingly they're popular. So let's dive on the things right away. Now how does it always look like? You put in a lump sum, and then after a period of time, say for example 5 years, then after that it starts to pay you a cash flow all the way until age 99 or lifetime, depending on plan. Different plans have different payout, and some plans even pay earlier than 5 years. There's a plan that actually pays after the 3rd year. So how it looks like, just to let you understand or get a feel of it, especially if you haven't seen a presentation before. It looks like this: $200,000 lump sum investment now. After 5 years, it starts to pay you a cash flow. Money comes out every month. As I mentioned, annuity means regular cash payout. And just to put numbers to it, typically plans right now are priced about this number: 1.5% guaranteed and 2.6% non-guaranteed on the capital itself. Now what do you realize? This equates to $250 per month guaranteed, as well as $433 per month non-guaranteed. Pretty good, pretty stable, very simple structure, correct? Typically annuity plans have been used for retirement planning, which means you're old, getting your old age, you want to have some cash flow for retirement. Then this is a very simple structure, gets you that cash flow, so you have income coming in. Again, when it comes to retirement, it's always about cash flow. It's not how much cash you have. Cash flow gives you the assurance that next month's expenses are settled and you can live life as per normal. And if you're not familiar with insurance plans, why is there non-guarantee component? Do take note also, for insurance plans, whole life plans as well as annuity plans, they put the monies into an insurer's par fund, participating fund. And what do numbers look like in terms of the participating fund? I've actually this public summary done by Wern Consulting, pretty good. It gives you a quick snapshot. Having said that, this is also a pretty outdated number. This is up to 2016. But the main idea of presenting this for you to see is that insurers on average achieve 3 to 4+% in terms of the performance of the par fund. Inside a par fund, if you look in terms of the benefit illustration, you see that invest primarily into bonds. There's some components of equity, there's some component of fixed income, there's some component of property investment also. So all in all, the insurer is in charge of getting that return, that non-guaranteed return for you. So far clear until here? If you have questions, leave them in the comment sections. But again, I can't pick up specific questions like, oh, I bought this plan from the bank, is it good? I can't address them. Again, there are regulators watching this video with you. I have to be a bit savvy in terms of what I can mention also. That's why I'm avoiding plan names. And I can't provide specific advice without understanding your background. So hopefully that clarifies things. But if you like it, again, like this presentation is helpful, smash on like. Hopefully we can reach more people together to educate them. Pros and cons, it can work, but also take note of risk as well as shortcomings of such a solution. The idea of leverage annuity really comes in when banks allow you to leverage. They take it as collateral, they fund the policy together with you. It makes it a lot more appealing, and I'm going to show you why. This is how it looks like. Just now we mentioned $200,000 on the policy. Imagine a bank is willing to lend you $140,000 of that $200,000. What does that mean? It means you only need to pay $60,000, correct? $60,000 from you, $140,000 from the bank. Hey, suddenly $60,000 seems like pretty manageable amount. So just now's case of $250 guaranteed and non-guaranteed 433 still remains. But right now, with leverage, with borrowing from bank to fund the $140,000, you realize that you incur an interest cost, correct? It's not free. And just to give you a snapshot as to what is interest rate environment looking like. Right now, banks typically charge, depending on what status you have in the bank, as well as what is the bank trying to present in terms of total package. So I'll just put a ballpark figure, 1% plus Sibor. So Sibor right now, 1 month Sibor is about 0.3%. So let's put 1.3% per annum as the interest cost. Now take note for this, it's usually on a revolving credit concept, which means you don't pay down principal when you buy property. You only pay off interest, which means the loan will keep running. There's no down payment of the principal itself, and eventually interest rates will start moving, correct? Which I'll touch on in a later point. So back to this point, if the interest cost in total is indeed 1.3% per annum, you realize that per month basis, your insurance charge, I've done homework for you already, 151.67 per month. That's still pretty low. As of now, you take this loan, you buy this policy, you have to start paying this interest now. I made the dollar sign in red as the outflow, and it's smaller than the black if you already realize what I'm hinting. It shows you that while you start paying now in terms of interest, after 5 years, what do you get? You get much bigger inflow than your outflow, assuming interest rates stay the same, correct? Which means even your guaranteed rate looks to be about $100 more than your interest cost if interest rates stay at 1.3%. If you put in non-guaranteed, wow, the equation starts to look fantastic. I've done the homework for you. If you do indeed get 433 in terms of non-guaranteed, which is the highest tier in terms of their projections, you realize that total wise, 250 plus 433 minus 151, that value times 12, and then you realize your yield is 10.67%. Fantastic, correct? After all, insurance plan is not meant to be a volatile asset. 10.67% net yield with leverage. That is where the special sauce actually comes in. Traditionally, par plans like these pay out 4.1%. Not too bad after 5 years. But right now, with leverage, you're getting 10.67% yield. If you haven't heard it before, you get blown away. I understand it. It is the pros of it. It works as of now. That's why the next part I'll highlight risk, because as always, I want to educate you so that you step into a presentation prepared, you understand the pitfalls, you understand whether it fits your needs or not. So you're a lot clearer. I'm not slamming any approach. I'm saying every approach, there are pros and cons, you fit it to your need. And a qualified advisor should run through all the possible situations. Now this portion, which I would like to highlight quickly for you, is the interest rate cost Sibor rate chart. What do you see over there? 1 month Sibor is the blue line, 3 month Sibor is the green line. And what do you realize is as of 2009, that was global financial crisis, correct? Interest rates tumbled tremendously and it stayed flat for the next 5 years. Do you realize that? 2009 to 2014, it stayed flat at 0 point something percent, thereabouts. Could interest rate continue to remain low like what we've seen in 2009? I think there's a small possibility that will happen, especially when COVID-19 has disrupted so many economies, governments are printing money, and that's why you see as of 2021, interest rates have tumbled tremendously. I used to dislike leveraging on such products. It is true, I've actually published a previous video on it, but right now with dynamics very different, you start to see me suggesting, hey, it could work. All you need to know is just whether it fits your risk appetite, whether you're aware of the risk or not. So indeed, if interest rates stay low, your 1.3% could persist for quite a long period of time, and that is up to you to interpret. So all in all, you see, this whole concept of a leverage annuity is very similar to buying a property, correct? You fund a small amount of deposit, and then you get a leverage, and then you kind of get yield on it. And that's why I prepared actually a summary table to run through with you to let you quickly understand these two differences. On the left, plan. On the right, property investment. And the first part to note is investment amount for any leverage annuity plan is much smaller. Some plans start off as little as 100,000. If you buy a private condo, 1 bedroom, that's already $500,000. Quantum size, very different. Eligibility rate, very different. Next, in terms of leverage, most annuities you can leverage. Again, check with the bank. But for property, of course you can leverage. Every property, there's definitely going to be an opportunity to get a loan for it. Leverage factor depends on bank. As I mentioned, 70% seems to be quite a good estimate as to what you can get from banks. For property investment, if it's your first loan, do note your loan to valuation is 75%. Now let's move on to the interesting part, which is cash flow. Now this plan, what you realize, cash flow comes after 5 years, correct? And they give you a guaranteed 1.5% as well as non-guaranteed 2.6%. But for property investment, your rent is not guaranteed. You have to secure a tenant, and typically the yield is about 2 to 4% only. In terms of cash flow stability, the plan, once it's after 5 years, as in this example, it is constant, very fast free, very simple. No outflows, no cost of acquiring this cash flow. But for property investments, you need to manage tenant. You have periods whereby there's empty tenancy agreements. You need to repair the fridge, you need to repair the aircon, and last but not least, there are agent fees, conservancy charges, property taxes, income taxes, especially if you're earning rental income from property. So much hassle. So that's why, in a lot of ways, I do think that a leveraged annuity is a unique product. It gives you a different way to get your money's working for you harder. Point number 10, very interesting, capital appreciation. Most plans, again, do check, the surrender value increases over time, embedded within it. Very interesting. You can use it for legacy planning. And you can even nominate, which is the bonus point. You can nominate to your beneficiary. Property investment, the value of property depends on market cycle, and all properties can decay in terms of value. So do note of that, especially for 99-year lease properties. And then for property, you need to sell, your beneficiaries need to sell property to crystallize the cash. Now you're getting an insurance plan, pay out as cash, 500,000, 1 million to your beneficiaries. Very simple. So you get what I'm heading for? This leverage annuity concept is very popular, and rightly so. If you use it correctly, it's to your advantage. But now, in this section, I'm going to highlight to you typical mindset mistakes or interpretation mistakes that I've seen in private clients. I reviewed portfolios many times, and I realized this increasing has been a component. And I realized that not many are aware of how to interpret the numbers correctly. So if you've gone through this tutorial, you're a lot more savvy. Again, I've taken time to present this. Help me smash on like. Together we can reach more people and help them become more savvy. Smash on subscribe. Along the way, I'll be sharing with you more investment ideas, as well as try to dissect various financial products and markets for you. First common mistake I'd like to highlight for you. Illustrated investment rate of return 4.75% on the benefit illustration does not equate to 4.75% per annum return on your policy. Do note, sometimes new investors are not too familiar with how policies work, and I'm surprised. Such a big investment, you should be very sure of things. Usually, the non-guaranteed return, as I mentioned to you, is only 2.6%, and it requires the policy par plan to perform at the illustrated 4.75% rate. So do note. And as always, if you look at the policy illustration, you realize there's one that's a bit more conservative, 3.25%, and the other at 4.75%. And the question is, if it delivers on the lower end of the scale, not say it's totally zero, there's some performance, 3.25%, what is the plan actually generating in terms of return? Typically, the non-guarantee rate falls to only 1.04%. Now, let me pause it a little while over here. Let me ask you this question. 1.5% guaranteed, 1.04% non-guaranteed. Total, 2.54%, correct? That's just your yield from the plan itself. What if interest rates are above 2.54%? Have you considered that? Have you been presented with that possibility? I've shown you before, interest rates can stay low, but it did spike up. I pull up the chart again for you to see. What happened in 2019? It spiked up to 1.8% Sibor. If you're 1 plus 1.8, total cost is 2.8%. What if the Sibor spikes up to 3% as what we've seen in early 2000s? You realize that your equation is very unfavorable, correct? So when this situation happens, your interest rate spikes up, your plan could be negative cash flow. So do note, at that point of time, if you are able to redeem the loan, you're safe, you're not bleeding. But if you're unable to redeem the loan, then you have an issue, you're negative cash flow. And that is a situation which is unfavorable. So if you have understood pros, how you can use the plan to advantage, as well as pitfalls, what to take note of, especially if you want to become a savvy investor. Now, if you like my approach in terms of how I manage retirement ideas, look for my links below. I'll be happy to work with you on a one-to-one basis, answer your questions personally. This is my style of building retirement. I believe the first layer of anybody's retirement, especially for Singaporean or PR, is that you should use CPF Life. That is the fundamental first layer. Income is consistent, there's just no risk to it, there's no management needed. The second layer to stack on is such a plan like this, a retirement plan. It gives you, again, consistent income. Let me highlight over there, consistent income. No need to manage it, very simple. And you also have some liquidity. You can cash it out fully if you really do need so, or you can take a policy loan to take out partial amounts. Then we stack on investment portfolios, shares, property, and you build. And I try to highlight in this summary table a simple interpretation of pros and cons, whether there's consistent income, whether there needs to be management, whether there's risk, and whether there's liquidity. So hopefully this has helped you. Again, smash on like if you haven't done so. I have a previous video also which I touch on some things that financial advisors have not mentioned before. I actually read through this book and I have some thoughts I'd like to share with you. Maybe in that video you kind of learn a thing or two a bit more on what to look out for, as well as my approach, and see if we are right fit for things. With that, I'll sign off inviting you to the video. Hopefully it can benefit you even further. Take care and goodbye.